In this video, I want to talk a little bit more about bonds, in particular, how we record premiums, discounts, and their amortization. This is a bit different from what you've probably learned in the past. In the past, we used a straight line method to amortize our premiums and discounts. This just took that total amortization divided by the total number of years, and then we just adjusted our interest expense accordingly. Most companies do use this effective interest method because GAAP does say that we should be using this one unless that straight line doesn't vary. But you'll see throughout this chapter that that straight line method and this effective interest method do create a big difference in your interest expense. So let's go through this. In the effective interest method, we're going to first compute our bond interest expense. The expense uses your effective interest rate. We're going to then compute the bond interest paid. In a journal entry, this is your cash amount, how much cash you have to pay out. For the cash amount, we're using our stated interest rate. And then we're going to take the difference in those to figure out how much amortization we have. So, just to kind of review, your bond interest expense is your debit. Your bond interest paid, that's the cash amount, that's going to be your credit in your journal entry. And your amortization amount is going to be a debit or credit depending on if you have a premium or a discount. When you're amortizing a premium, you're going to need a credit. When you're amortizing a discount, you're going to need a debit. That's because, and if you can take notes anywhere in here, that's probably a good thing to write down, is that if you have a discount on a bond, you're going to get a higher interest expense over the life of the bond. And the reverse is true for your premium. If you have a premium, that's going to create a lower interest expense over the life of the bond. So let's walk you through a homework problem here, kind of give you some information as to what to pull out to make it a little bit easier, and how to do the journal entries, as well as a few other items. So first, when we're looking at the problem, we're going to make sure we identify each piece. For example, this 4 million. Now that's your par value of your bond. That's the amount you have to pay back. That's the amount that you're going to record. That 13% that's showing up afterwards, that's the stated interest rate. That's the amount that was recorded saying that this bond will pay 13%. That's your stated interest rate used to figure out that cash portion of the bond. Now this bond is sold at a premium because it's higher than the par value, and the yield is going to be your effective interest rate. It's going to be a premium because my stated rate is higher than my yield. So let's go ahead, go through all of these journal entries one by one and kind of show you how to calculate these interest rates, how to calculate the premium and the amortization, everything that has to do with a bond. So first one, the issuance. The issuance is Just simply recording the cash amount you got for the bond, your cash proceeds, as well as the bond payable. The cash proceeds is the amount you got for the bond. We're going to debit that for $4.3,918,000. Your bonds payable is credited for the par value of $4 million, leaving us a premium of the difference of $300,918. So that's the issuance. Now you also want to note that in this chapter, most of these are semi-annual interest. That means we get paid twice a year, but our stated rate and yield are always presented on a yearly annual basis. So we need to adjust for that. So for 2, when we're recording that first interest payment on December 31st, we're going to debit our interest expense. We're going to then debit our premium. You see you have that credit here. Therefore, when we amortize it, we need to debit that. And then finally, we're going to credit our cash. So just to be clear, up here when we talked about the premium and the discount of the amortization amount, our original journal entry, the premium, creates a credit. Therefore, when we amortize, it's going to be a debit. And the same thing is true for that discount. The discount creates a debit, and therefore when we amortize, it'll be a credit. So we're all on the same page there. But now let's calculate the amount. We have to figure out our interest paid, the cash amount, as well as the interest expense amount. Now the cash amount is coming from our stated rate of 13%. So we take our par value times that stated rate times 6/12, since we're only applying 6 months, which would be 260. And so I'm going to put that here in my cash account. Next, I have to calculate my interest expense. Just to review, this is where I take my carrying value of my bond times my effective interest rate. Since this is my first interest payment, my carrying value is going to be that $4.3 million amount. I'm going to multiply that by my effective interest rate, or my yield, and times that by 6/12. That's going to give me 258,055. And the difference between those two is what I'm going to be able to amortize. So the difference is 1945. And again, I get this, get a different color here, that 260 minus the 258,055 is going to equal to 1945. So let's look at what going forward that looks like. This is when it gets a little tricky. The next 6 months interest expense, the account names going to be exactly the same. Those don't change. Your cash amount does not change. That will always be the same. Every interest payment. But now we need to calculate what our new interest expense is going to be. So I take my carrying value, and my carrying value is going to be my original amount. Oops, that should be 9. That's my original carrying amount. But remember, I did amortize a portion of that premium to give me that new carrying value. And then I'm going to take that amount and multiply it by that 12% and multiply that by a half a year. That amount is going to come up here for my interest expense, which should be $257,938 if I did my math right. And again, to get that difference, I'm going to take the 260 minus the 257,938 to figure out how much I'm amortizing this round, which is $2,062. And that's how much I will amortize my premium by. All right, we're going to do one more round. See what that looks like at the end of the year. Again, our interest expense doesn't change. The the account name, I shouldn't say, premium, cash. That cash amount again will not change. But now we have to recalculate our interest expense. You're going to need to do that for every interest payment. So now this time, we're going to have to recalculate that. We're going to subtract that first one, subtract how much we did that second round. That would give us our new carrying value. And then we're just going to go ahead and do that multiplication. That again will give us our interest expense. If you do all that math, it should come to $257,815. We're going to do some subtraction again. And we should get 2185. To give us our amortization of our premium. So that walks you through, gives you a little bit of practice regarding calculating the interest expense and how much you're going to amortize, as well as finding that new carrying value. In the fifth question here, we want to now kind of figure out what is the bond premium, the premium on bonds payable at the end of the year. So what amount are we showing on our balance sheet for this bonds premium? To do that, I'm going to look at our bonds premium. And look at everything I've recorded to date. So In number 1, we have a credit for $309.18. And then we're slowly recording amortization 1945, 2062, and 2185. Those are all credits. All I'm going to do then is figure out how much I have remaining. And that would be the amount that you would show on your balance sheet as a credit that's left for your premium amount. Now let's go ahead and look at our next piece of the puzzle. We want to know what is the amount of interest expense that would be showing on that income statement for 2021 in regards to this bond. Now, one thing to note is that sometimes when they're asking these questions, they're asking for a variety of different things. So please be sure that you're reading these questions carefully. They only want the interest expense in 2021. So if we go through our journal entries, we'll notice that only number 3 and number 4 relate to 2021. So I'm going to scroll back down. I'm going to find my journal entries for number 3 and number 4. I'm going to pull out that interest expense for those years. I'm going to then add that up. And this was number 6. If I add those two amounts up, I'm going to come to, oh shoot, undo that. Sorry about that. 257,815. Add those two up and you get 515,753. And the last thing that they want to know, what is the total cost of borrowing this $4 million? So this is one good thing that you're going to, if you ever go into bonds, this is one thing that they really want to analyze to see if it's worth borrowing that $4 million. So let's look at that last piece. Let's figure out how much this is going to cost me. So remember, interest paid, that's the cash amount. We want to figure that amount out. So it was 4 million times that stated interest rate, and this bond was 20 years. So we're going to pay that annual amount for 20 years, which comes to $10,400,000. Next, we have to pay back that $4 million, right? So we're going to pay back the principal. So a total amount we're going to pay back is $14,400. We're going to compare that to our cash we received. This goes back to that original journal entry, that 4.3 million. And the difference in this amount, which is 10,099,082, this is the total cost of borrowing that $4 million. Costs us a lot of money to get that $4 million now. So this is a lot of information. When we ask you this on a test, we're not going to expect you to take so much time going through all of this. So I want to show you again, what does this look like as a multiple choice test question? So again, when we're looking at the test questions, some of them are going to be very easy. and some of them are going to be a lot more difficult. So make sure what you go through first is what do they want. Usually you can find that in the last sentence. So before I read anything else, I'm going to go through and say the effective interest method. What is the bond interest paid for the full year of 2020? Now I'm going to go back through and kind of dissect these pieces. So that 2 million, that's easy. That's my par value of my bond. This 12, that's going to be my stated interest rate. I might make myself a note so that I don't get flustered. That stated interest rate is used to determine my cash paid. And then I have my yield over here. That's going to be used to determine my interest expense. And then it shows me how much my cash proceeds were. I don't need all of that for this problem, but it's going to be helpful for you to start recognizing what each of those pieces mean and to pull them out each time so that it just becomes habit. So again, they want the bond interest paid. So if I want to know the interest paid, I'm looking at that 12%. So all I need to do is take that 2 million times the 12% because that's an annual interest amount, remember. And that's going to give me the 240,000 because they want the interest paid and not the interest expense. The answer would be D. So do they give you all this information every time? Yes, they're going to. What the goal of that is to make sure you understand what it is you need out of that information given. Let's look at one more. It's a little bit more complex, same information, but now, again, I go through what they want first. What's the unamortized bond premium at the end of the year? So at the end of that first year, what is the unamortized bond premium, or the amount that's listed as your premium on your balance sheet? This one, saying the same thing as the last one, but this one's going to be a little bit more complex because we now not only need to figure out how much interest we paid over these years and then figure out how much was amortized. So we kind of have to walk through that whole process. So in year one, our interest expense, and there's no way to shortcut this because we need that amortization amount for the second part of the year. So this is in June. I should say year one in June. We have our interest expense. We're going to then amortize that premium, which is going to be a debit, and have that cash amount. So we know the cash amount's probably the easier piece to figure out. It's that 2 million times that 12% times 6 over 12, or 120,000. We're going to put that in here. The interest expense, on the other hand, is going to be a little bit different. We need to calculate that amount out. That's going to be for the first time through the carrying value times that 10% times 6 over 12, or 107,725. I'm going to subtract those two to show how much I'm amortizing of that premium. But they want to know for the full year, so I'm not done. I have to do that second year again. So I'm going to do that next. So this is my year one at the end of the year. I don't know why I'm putting the first. So again, we have our interest expense, our premium, and our cash, which doesn't change. But now we have to figure out what our interest expense is this year. We're going to take that 2154. We're going to subtract what we've already amortized, and then go ahead and multiply by our yield, and that's 6/12. That should give us 107,106, and I'm rounding a little bit here, which would then give us a premium amortization this year of $12,894. So as you can see, just like we did in all of the homework problems, sometimes we have to do all of these journal entries to get to where we wanted to be. So we're not there yet. What they want to know is how much is our unamortized bond premium. So let's look at that. We needed to do all of this to get there. Our premium is 154, right? 154,500. Then what we're going to do is subtract out the amortization that we did. We're going to subtract out this. We're going to subtract out this. Let's see. 154. And I think I put in some wrong numbers. Oh no, I didn't. So if I add those two numbers together, whoops. If I add these two numbers together, the two premiums that I amortized, I get 25,169. If I subtract that, I should get 129,850. And again, D should be your answer. That's the amount of unamortized bond premium that's sitting on that balance sheet at the end of the year. So this one shows you I had to do a lot of work. It all related to that homework problem, all part of those journal entries that I probably needed to do to figure out that one little number, compared to another question they could have asked, which is just simple. So make sure you read exactly what they want, dissect that question, and get the information that you need. Hopefully that helps explain these bonds a little bit better and the amortizing using that effective interest rate. If you have more questions, please let me know.